Today we're looking at a really comprehensive financial analysis report on Boeing.
Yeah, a big one. The title is BA Stock Analysis, the Massive 2026 Breakout Begins.
Right, and the whole argument is built around this idea that the worst is finally over for them. It hinges on the Spirit AeroSystems deal and, critically, that positive free cash flow number in Q3 2025.
The foundation here is really good. I mean, it correctly flags the Spirit acquisition as the key and points to the cash flow inflection. But when you use a title like Massive Breakout, you're making a huge promise.
Exactly. A simple turnaround story isn't going to cut it. It needs to feel explosive.
Right. The conviction has to be backed up with, overwhelming proof.
Okay, so let's dive into the first pillar. Let's talk about risk. The analysis does call out the 777X delay and that, a $4.9 billion charge.
It does, but then it sort of just concludes that the bad news is priced in.
And that feels a little too easy.
It is, so the analysis should more robustly connect the operational catalysts to the explicit mitigation of future risk factors to support that aggressive, massive breakout claim.
Okay, unpack that a little.
Well, the weakness is one you see in a lot of, aggressive bull arguments. It focuses so much on the good news, the Spirit deal, the positive FCF, that it lets a really significant financial risk, that almost $5 billion charge, get swept under the rug.
Right. It leaves the reader feeling like maybe the complexity of this whole thing is being understated.
Exactly. It makes the conclusion feel a bit less secure. If this turnaround is for real, the analysis report needs to show that the company can actually withstand future shocks.
That's a great point. It's not just about showing the execution is getting better, but that the financials are now, shock-proofed. Because something else will go wrong. It's aerospace.
It always does. So my suggestion is to really dedicate some serious analytical weight to showing how those three pillars, execution, demand, and cash, directly create a buffer. A buffer against setbacks that the Spirit deal itself doesn't solve.
So we need to move the story from we stopped the bleeding to
we can now take a punch. How do you show that?
So how do you actually quantify that? I mean, a nearly $5 billion hit it's just too big to wave away.
You use the future cash flow as the explicit shock absorber. So for a concrete example, you could take the 2026 FCF guidance, that low single-digit billions number, and show specifically how that cash generation just swallows the impact of the $4.9 billion charge.
So you frame the charge not as this lingering problem, but as a one-time cost that the next year and a half of cash flow can comfortably handle.
You got it. It reframes it as a manageable expense that's already covered by future strength.
Okay, I like that. But what about the risks the Spirit deal doesn't cover? Like engine suppliers are still external.
And then immediately explain why the massive backlog and strong demand environment make those concerns less critical for the next, say, 12 to 24 months.
So the record high demand basically acts as a firewall.
It becomes the ultimate mitigation tool.
Yeah.
And a third way, and this one is a really sophisticated reframe, is to position the 777X delay not just as bad news priced in.
Right.
But as a strategic decision. It's a contained financial hit that lets management focus all their energy and capital on the real cash cows, the 737 MAX and the 787.
So taking the hit now on a delayed program actually strengthens the execution pillar where it matters most for near-term cash.
Exactly. It's management taking control, not just reacting to a crisis. It turns a liability into a strategic choice.
That's a powerful shift. Okay, that nicely leads into the next big point, the gap between a turnaround and a massive breakout.
The report makes a very strong case for stabilization. That 30% year-over-year revenue jump, the FCF turning positive, it's a solid recovery story.
It is. But the title promises so much more. This is where the analysis needs to more clearly articulate the mechanism by which operational stability translates into the massive multiple expansion required to hit the $285 bull case.
Target.
Right. This is where we really need to apply some pressure. The argument right now basically says the bleeding has stopped.
And delivery capability is being fixed, which is great. It's necessary, but that just gets Boeing back to, being a functional company again.
Functional parity doesn't justify a nearly 40% upside from where the stock is. So we see the company is working again, but we don't see why the market should suddenly pay a huge premium for it.
That's the core weakness. The connection between the operational fix and the valuation jump is implied, not quantified.
So what's the suggestion?
The analysis has to use those hard financial numbers, the FCF reversal, the 2026 guidance, to actually project a higher valuation multiple. It can't just state the analyst targets. It has to show the math based on historical aerospace metrics. The return to predictable FCF is the only thing that justifies a massive breakout.
So the FCF is the engine for the valuation, which then justifies the 285 target. How do you show that in a way that's, really persuasive?
You have to anchor the whole thing in cash flow. First, use the Q3 positive FCF and the 2026 guidance to set a valuation floor for the current price. Then, and this is the killer move, calculate the implied free cash flow yield at that 285 target.
Ah, okay.
That calculation forces the analysis to quantify exactly why the market should pay a higher multiple. It ties the bull case directly to a number you can see in debate.
That makes it so much more robust. It moves it from just a projection to a demonstrable metric.
Yeah. And building on that, for a second example, since demand isn't the problem here, you can show how stabilized production rates from the Spirit deal will actually reduce CapEx or working capital needs faster than the market expects.
So you're arguing for FCF acceleration, not just FCF positivity.
Precisely. You're showing outperformance potential. That's how you get to massive.
I see.
And third, to really nail it, you have to think beyond just consensus. Use the idea of future dominance in the duopoly. Now that they have fuselage manufacturing in-house, what competitive advantages does that create? That vertical control is an asset their main competitor can't easily copy.
And that warrants a long-term premium multiple that gets you to 285.
That's how you do it. That's the bridge from turnaround to breakout.
Okay, that's incredibly strong. Let's talk about the final piece, which is structure and flow. Right now, the technical analysis, the part about the stock reclaiming the $200 level, is in its own section at the very end.
Yeah, it feels a little disconnected.
It does.
So integrating the technical breakout discussion earlier in the report would strengthen the overall structure by using price action as an immediate validation of the fundamental turnaround.
Talk about the risk of keeping it separate.
It's a narrative timing issue. You present this spectacular fundamental news, huge revenue growth, cash flow reversing, and then you just move on. The market's reaction, which is a huge piece of the puzzle, feels like an afterthought.
It's like saying you won the lottery, and then 3 pages later mentioning, oh, by the way, the money is in your bank account. The market's reaction should be part of the proof.
It is part of the proof. So the suggestion is purely structural. Move the discussion of the technical breakout of reclaiming that $200 level to immediately after the financial turnaround section.
So you create this powerful 1-2 punch for the reader. Here's the amazing Q3 news, and look, the market immediately started to price it in.
Yes. It gives the whole thesis immediate credibility. For a concrete example, right after you lay out the Q3 revenue and FCF numbers, you pivot. You say something strong like, the market immediately validated this fix, driving the stock to reclaim the $200 psychological level, confirming aggressive bullish momentum.
You're using the market's own behavior as a piece of evidence. I love that.
And it makes the whole report flow so much more logically. The new narrative becomes problem, which was delivery in cash.
Then the fix, which is the Spirit deal and the Q3 numbers.
Then the market confirmation, which is the technical breakout over 200.
And finally, the future potential, which is your valuation and the 285 target.
Exactly. It's a much clearer, much more persuasive story. It's what you need when you're selling an investment idea with that kind of upside.
That narrative structure is it's dramatically more powerful. It helps the reader accept your conviction.
It gives it a sense of urgency.
Okay, I have to say, the core material here is excellent. What I really like is that clear identification of the Spirit deal as the catalyst and the FCF reversal as the proof. It's deep, it shows real sector knowledge.
For sure, it's very strong.